I say, okay, in the first year with this business, I'll make $100 million revenue. Yes, nobody will believe that, right? From 0 to 100 million. So they look at the assumption and say, no, I'm out, right?
That's one of the major differences I see in venture capital, though, because in venture capital, they want you to think that. So that's one of the things I see when I think of equity crowdfunding versus venture.
The VC game is kind of cruel. So they let you dream, basically. So then you make big forecasted, and then they hold you accountable.
Yes.
And then you never meet them. And boom.
Take your company.
They got you.
Exactly. So that is a big difference. That's part of why I actually think equity crowdfunding is going to change the VC game. Because
eventually, yes,
they're going to have to adapt to this innovation.
In general, as a rule, on equity crowdfunding, let's say everything equal, you can sell at a higher valuation than VCs by default. Why? Because with a VC, you sell wholesale. It's one person buys everything. With crowdfunding, it's retail. That means if I buy retail, I pay more. So it's the same thing as an investor, because I'm buying retail, I'm not buying everything wholesale, I have to pay more.
That's a good way of explaining it. That's really good.
Yes.
So as a business, you can set a higher valuation, because what he's saying is venture capitalists, especially right now, venture capitalists can set whatever terms they want because of Corona. They can say, look, you're not going to stay alive for 2 years. So you either take this deal or don't. And I've heard of companies having to take down rounds, meaning they have to make their valuation lower, even though they have traction, just because of the scenario we're in with this pandemic.